Dear valued investor, we are all now close to 2 months into our ambitious New Year's resolutions and hopefully successfully implementing new healthy habits. For me, the 2022 Phillies made me create a personal goal to exhibit more emotional competence when supporting my teams. I had a reset this past Super Bowl Sunday, so I am starting over, like many other Eagle fans. When we look back, it's easy to identify the economic and financial challenges, but if we look closer, we can also uncover some opportunities. Let's not forget what we learned in 2022. The Federal Reserve will take swift action to defeat inflationary pressures, as demonstrated by the sharp interest rate increases. We also saw that severe inflation, coupled with the Fed's interest rate hikes, had a larger than expected impact on the stock and bond market. So, where are the opportunities for investors? In the bond market, we've uncovered value, especially for income-oriented investors. This is a welcome change after nearly 20 years of difficulty in finding stable, income-producing investments. Turning to equities, the early weeks of 2023 look promising. Inflation is still elevated, as seen in the data, but we think it is too easy for the inflation hawks to think prices are surging again. The Fed is data dependent, specifically on the core drivers of inflation: energy, housing, and wages. And unless prices spike in these areas, it is expected that the Fed will remain on course, which we believe is to end rate hikes in the first half of the year. There are renewed hopes for a softer landing for the U.S. economy. Our expectation is that the economy will either narrowly avoid a recession or enter a mild, short-lived recession in early to mid-2023. These factors have allowed investors to begin charting a more positive path forward, which we believe will continue despite some potential choppiness in the markets. We continue to favor U.S. equities over international markets, despite pressure that we expect on domestic profit margins. The international markets have also begun to show some signs of life, as inflation looks to be peaking in the UK and Europe. Emerging markets have bounced back slightly, although uncertainty over China's economy remains a wild card. Solely looking at valuations reveals several asset classes and sectors to consider in 2023, including small and mid-cap stocks, value stocks, international stocks, and the energy and financial sectors. At first, moving down market cap to small and mid-sized companies now might seem counterintuitive. During bear markets, especially those that are accompanied by recession, smaller companies with generally weaker balance sheets would be expected to lag their larger cap cousins. But at current valuations, recession appears largely priced in for small caps, particularly for the more profitable companies. There were few clear winners recently besides the energy sector, but value stocks certainly have put on a good show. Value stocks are, by definition, cheaper than their growth peers. That's how they end up being classified as value stocks. However, the size of the valuation discount matters, and this could make value stocks relatively more or less attractive against growth. We maintain a slight preference for value stocks over growth, including a positive view of energy and a negative view of consumer discretionary and technology. Within our sector analysis, it's easy to think that after a large rally in 2022, that the energy sector is expensive, but it actually is not. On a price to earnings and price to book basis, both the energy and financial sector continue to trade at a discount to the S&P 500. Fundamental challenges remain for the financial sector, particularly the inverted yield curve. Short-term interest rates remain higher than long-term rates, signaling a recession and creating a less profitable lending environment. Overall, we see reason for renewed optimism when it comes to the markets in 2023. Should the Fed pause rate hikes in the near term, as expected, we may see a nice stock market rebound supported by falling inflation, reasonable valuations, and stable interest rates. Further equity market volatility remains a risk, but we believe we will see more positive outcomes from equities and bond markets this year. Please contact me if you have any questions. Stay safe and stay the course.